Hey, everybody. A little update on what I'm seeing in markets, in the volatility space in particular, particularly because it's option expiry week, and things can change quite drastically sometimes from expiry week to the next. A lot of people think expiry weeks can be very, very volatile. That's certainly the kind of mainstream business media kind of idea that, oh my goodness, it's expiry week. Things are going to be super, super scary. Sometimes that's not really true because expiry week has a lot of that positive gamma and that kind of keeps a clamp on things. Yet it's the next week where things can potentially change. So not always true, but much of the time that's the case. And we're going to talk about how that might be the case here. And then at the end, I'm going to give you an idea for a trade that I really like on a company that I really like. So first of all, my enhanced masterclass, vol class was really, really great. We're going to do another one in March. People were blown away. Here's a review literally that just came in yesterday. I wanted to thank you for all that you do. I'm up 64 grand since I bought your courses, mentorship, 4.6% a month. I cannot guarantee that for everybody, but this guy, he actually came to me and he said, you know what, I've spent like 3 grand on these courses. They were utterly horrible. And he was so hesitant to go with me. And I said, listen, you're going to get something you have never seen before. There is so much crap out there. You are going to get something that is going to actually have the light bulb go off above your head. And that's what I love to see. I actually teach people things to people that are almost the complete opposite of what they're learning out there. It's unbelievable. Some of the things that are commonly thought of in the area of options are actually not really very true. So I give people the ability to think outside the box. So we're going to be doing another one of those events. You're going to get so much stuff with it. And the thing is, it's not just a live event in March. You get all the stuff right away. You get something like 12 or 13 hours of videos of my system, how to do things, my Volatility Ninja series. You get my Nomad course, which is super, super volatility concentrated, when to do things, when not to do things. You get all that stuff so you can prepare for the actual event. So what are we seeing in S&P? Well, we've got this very nice pattern. We broke out beautifully this year out of this downtrending channel, and excuse me, and then we started to kind of do a very similar thing, which was lower lows and lower highs. We did the exact same thing. So we touched that breakout spot. We touched that breakout spot again here. And then finally, in the last week, we've blasted through this mini channel that we've been in to make new highs. So generally pretty constructive on the S&P, I've got to say. Part of that is I think that bonds have stabilized a little bit, right? We see the 10-year back around 450, 460. That's somewhere the market can kind of wrap its head around in terms of we're not getting too high. We'd start to get nervous maybe around 5%, 5+%. That would get stocks a little bit nervous. But for now, quite calm, and that's really supported by the MOVE index, which, by the way, just Google the MOVE index. You should really be watching this. We saw some very elevated levels back in October ahead of the election. Much, much more elevated versus the VIX than we've seen in many, many years. That has come down, and we're sort of down near the lows of the past year. We've touched those levels a couple of times. So that's good to see from the perspective of wanting to see less nervousness out there. And what did we see yesterday? Well, we saw the market pull back. We've seen a lot of these things. We get a little bit of news, a little bit of data, perhaps a headline from the administration, and things pull back, knee jerk. We keep bouncing back. Here we came to that vol trigger. I'm going to talk a little bit more about how this works, but basically we bounced around and we tested it a few different times. This is where there was some support from some puts, positive gamma, which allows dealers. I was a market maker for a dozen years, so I lived through this kind of thing, having to basically, support markets as your hedging activity basically supports markets as it comes down and supplies markets as it goes up. So it tends to dampen volatility as we go up. We can see this in the S&P on the 2-hour chart. We can see this struggle right here. This is the point where maybe we were going to dip back into here. Nothing to get too alarmed about, but it really struggled and finally bounced back, and the vol trigger held, which is really, really good. So part of the reason is that we really do have a happy picture overall. Yes, we have a VIX of 15 to 17. We popped into the little bit higher level of that range yesterday. And so that's historically, that's a little bit on the high side. But in my view, in light of the administration, the headline risk, what's going on out there, perhaps on the rate side, on the inflation side, VIX 15 is kind of almost the new 13 for now. I'm not saying that it can't get into the 14s. I think we will get into the 14s sooner rather than later. But for now, 15 is kind of a bit of a floor for us. But what's more important is that you have happy pictures like this. So this is your VIX futures curve, very much in a happy position, a contango, which is futures months higher at each subsequent expiry and above that VIX cash. So this is basically your picture of health. And that plays into some of these products. We have a pure vol strategy in our community, which is incredible. You get membership into that with my programs. You can see that SVIX, which plays short volatility, it's now making money simply from the structure of this that we're looking back at on the left side here. It will make money each and every day, all else being equal, because of the roll yield effect of this particular product, which we don't have to get into in too much detail. And of course, that means the opposite product, which is the VXXs, UVXYs, which are long VIX futures effectively, and suffering from that very roll yield that I said helps the former two products. So we're losing money in these products, we're making money in those products. And this is a structure that exists probably 80+% of the time over history. So this is really the more favored position for VIX futures, right? Markets generally find a way to calm down eventually, fortunately, and they get back into this happy picture. So what we have right now is a positive gamma backdrop, which means again, the dealers are able to support markets as they come down. They're able to supply markets as they go up. And one thing we have is this collar that's starting to come into view a little bit more. So we have the JPM collar, which expires at the end of March. So we have this very large call strike because what the JPM collar product does, and it's a very big product, 21 billion in assets, been around for about 11, 12 years. And so it's very, very popular. It owns the market and it buys a downside put spread. And then after it pays for that put spread, it goes, well, what call do I need to sell to pay for that? It's trying to basically have a zero cost collar on this structure, which is a cool thing. I like collars very much at certain times. It's a cool idea. It kind of gives you a little bit of protection on the way down, but it does supply the market with all this gamma up here, this positive gamma. So dealers have to buy all these calls. And now that acts as a bit of a positive gamma resistance. So on the way up, dealers have stock to sell, futures to sell as we get closer to that strike. And as we go through the strike, they have more to sell as well, right? And so I've done videos on the functioning of that. It's in my Volatility Ninja series as well. I explain the exact math behind it because everyone talks about gamma, but they don't really talk about why it happens, how it happens, and the math behind it. So interesting to know. And it's important to know because as we get closer and closer to expiry, this gamma becomes much more pronounced. But at the same time, if you are down in the 6,000 sort of thing or a bit farther away from it, it can actually act as a bit of a magnet because you cannot be short too many futures. Your deltas aren't high enough. That's called charm. As time goes on, the delta of that out of the money call drops, and you can't be short as many futures. So people have to actually buy back hedges. So that gets into some of those second order Greeks that we don't need to dive too deeply into right now. All we need to know is that there's some supply up there, which is going to probably help to keep a limit to the upside on markets. And that's a good thing because down around this 61, 65, I probably have this arrow drawn a little bit too high here. We're keeping the market from getting into this negative gamma area, which could act as an accelerant up towards 6,200. So right now, this is sort of acting as a little bit of a wall to prevent us from getting into a bit more of a melt up type situation. So I expect that to hold for now, given the sort of headline risk and the overall kind of persistent sort of durable fear that we're seeing out there. Just slight fear, right? We have markets all-time highs, but there's sort of just a little bit of nervousness that I think we're seeing play into the VIX in particular, as it sort of just, it has kind of a little bit of a memory as well of what happened in August and September. And we have dealers very, very short upside VIX calls as well. So, skew could be a little bit higher. People are buying downside protection, but really they could get more aggressive, to be honest. But right now, dealers very, very short upside in VIX, which probably helps to keep it just a little bit sort of firm. Now, here's that situation that we see from Gamma, very positive Gamma in here. But what happens next week, right? We're going to lose 61% of our current total Gamma post expiration. So this is a big thing. We're going to go from very, very positive to much less positive, although that JPM caller strike, that call strike is still there. We're going to lose a little bit of that, right? So what some people call this is moving, you were free to move about the cabin a little bit more. So some of this buy the dip this week could disappear a little bit. So you want to sort of jockey for position a little bit, expecting that next week, as we get into it, could be a little bit more volatile. Could be, no guarantees. But given the gamma backdrop, we're going to have a little bit less of that positive supply that can tend to keep us pinned. But for now, we still have some positive effect from that caller, and we'll see how that plays out. So earnings next week, of course, we've got this very, very big date. I wouldn't be surprised if we just kind of we just kind of float into NVIDIA without too much fanfare. But of course, that is a really, really big earnings report. I don't, as I said last time, I said, a couple times even, I've said, listen, this isn't as important a stock as it used to be. And I've been 100% right on that. The broader market has taken over. It isn't all about semiconductors. It isn't all about AI anymore. We're seeing some great moves in other sectors that are partially positive in that, given the Trump backdrop and regulations and tax cuts and things like that. But let's talk about our new section, things that make you go, right? So here we are from Torsten Slok at Apollo, pointing out something that the idea is that Trump wants to replace some of the cuts from income taxes with those tariffs, right? This tariff idea is supposed to kind of fuel and finance some of the things that we're going to be losing from a revenue perspective. And so he says, listen, income tax is around 3 trillion, total imports around 3 trillion. So they offset perfectly, don't they? But it's not that clear because that's all else being equal. So if you raise tariffs and everybody just continues to spend the exact way they did before, then this math can potentially make sense. But if prices go up, anybody who knows basic economics knows that as prices go up, people are sensitive to that. They are going to pull back on demand. So the question is, well, how much more in tariffs do you actually need to account for that pullback in consumption, in spending, right? So then maybe you need 200% tariffs on imported goods. Well, then that kind of creates a little bit of this weird kind of spiral going on. So how does this math work out? So this is maybe some of the things that the markets are kind of grappling with at this point, which honestly makes me a little bit sort of curious as to why the move index is really low. So I think it's kind of interesting. I think TLT vol is starting to get a little bit interesting. A few spots out there where I think option pricing getting a little bit cheap. Now, where's my idea? Well, Uber, anybody who follows me knows that I've loved Uber for a very long time. I just think companies with these incredible moats like Uber has in many ways, robotaxi being another issue, but I don't think they're going to be left out in the cold when it comes to that stuff. They're going to make sure they're right in the mix, in the conversation. And I think they just have all these eyeballs. I mean, it's like, what do? You Uber. No one says, oh, I'm going to grab a Lyft. Everyone says, I Uber, and they're turning this into revenue in so many different ways. So I love this company. It's had a nice big bounce back after curiously, sell off after those earnings. But then Bill Ackman came in and said, I love this company. So it's gotten a little bit of a resurgence, and it's really hanging in there, even in the face of some small sell-offs in the market. It really hasn't been selling off. So I think that the vol levels are a little bit low. I'm not super excited about selling cash secured puts or really taking advantage of volatility here in that sense. But I think what you could do is you kind of sell like maybe an April 75 and use that premium to fund some upside. And that's going to give you a little bit of a nice bit of convexity to the upside, right? You get a little bit of that leverage. So when vol levels are low, I kind of don't love to get too aggressive from a vol selling standpoint, but I don't mind using some of that if I have to finance upside, right? So I'm giving up something, a little bit of that. I'm giving up the income in order to finance leverage, and I love that. In a play. That's giving me what I really do want in a stock that I think could go higher. So you sell that 75, that's going to pay for most of the 90 potentially. That's what I'm doing out there. It's going to cost me maybe 16, 17 cents to do this, but I'm getting something that obligates me to buy Uber below 75. But to the upside, I'm going to get this nice full convexity. You could also turn that into a call spread to the upside to cut down on the cost of this play and get that cost down to zero or even a credit. So that's a play that I kind of like in a name that I really like right now. So hopefully you guys enjoyed that, and we will see you in the next video.